Have you ever wondered why houses cost so much? Or why some people struggle to buy one while others can buy two? Let's take a journey into the world of the housing market. Imagine a city full of houses, some empty, some full of people. Prices go up and down like a seesaw, and sometimes it feels like you're just watching a game you don't understand. Today, we're gonna break it down, step by step, so it all makes sense. The housing market is like a big puzzle. At the heart of it, you have buyers, sellers, and banks. Houses themselves don't move, but their prices sure do. When a lot of people want to buy a house, the price goes up. When fewer people are buying, the price goes down. Banks play a huge role. They lend money to people who want to buy houses, and the interest rates they set affect everyone. High interest rates make borrowing more expensive, so fewer people can buy. Low rates make it cheaper, so more people rush in. It's like a game of tug-of-war between buyers, banks, and the houses themselves. For example, imagine a single buyer looking at a house. If the price jumps suddenly, they feel shocked or worried. Multiply that by thousands of buyers, and suddenly the market is buzzing, full of energy, tension, and sometimes panic. As more people rush to buy houses, prices start climbing faster than most people expect. Buyers feel stressed, houses start to feel out of reach. Meanwhile, banks watch carefully. They adjust interest rates, trying to balance things. Sometimes prices rise too fast. People get nervous. Houses become too expensive. Buyers get frustrated and may stop buying altogether. The market slows down. You can see this in neighborhoods where houses sit empty or where a for sale sign seems to stay up forever. Then there's the crowd effect. When everyone expects prices to rise, more buyers jump in, thinking, I need a house now before it gets too expensive. This pushes prices even higher. But when the crowd stops buying or when rates go up, the opposite happens. Houses can drop in price, and suddenly the market is calm again. This cycle repeats. Rising prices, panic, slowdown, recovery. Every decision by banks or buyers can create waves across the market. At some point, the market reaches a turning point. Buyers realize that they can't compete with the rising prices or that rates are too high. Crowds shrink. Houses are still there, but fewer people can afford them. Banks adjust. Interest rates go up or down to stabilize the market. This is when you notice patterns forming. Prices level off, buyers return cautiously. Houses get sold again, but more slowly. It's the market finding balance after a period of chaos. The most important thing to understand is that this is normal. The housing market isn't broken, it's just a system responding to people, money, and expectations. Like any system, it has cycles: growth, tension, correction, and stabilization. So what can we learn? Houses aren't just about walls and roofs, they're part of a bigger economic story. Prices rise and fall, but understanding why it happens can help you make smarter decisions, whether you're buying, selling, or just watching the market. Remember, the housing market is a long game. It's not about quick wins. It's about patience, understanding, and timing. And while it may seem confusing at first, once you know the patterns, it starts to make sense. Next time you see a for sale sign, you'll know it's more than just a house. It's part of a living, breathing market reacting to people like you and me. If you found this explanation helpful, don't forget to like this video. And if you want to see more stories about how money, markets, and the economy work, make sure to subscribe to our channel. Hit the bell icon so you won't miss our next video.